Okay, so what I'm going to do today is, my idea is not really an idea, okay? My idea, as it were, is more of an affirmation. It's an affirmation of the ability of the legal system to correct economic injustice. Specifically, what I'm going to be talking about today is the impact of the housing crisis that we are still presently experiencing on minority homeowners, and specifically the impact on minority neighborhoods. It's not often that a business lawyer gets to talk about social justice, so I'm delighted to be able to do this. Okay, let's talk about some terms. What we're really going to be talking about today is mortgage financing. Mortgage financing specifically to homeowners. In the universe that we're going to be talking today, there are two types of loans. The first type of loan is a prime fixed loan. The elements of a prime fixed loan: a lower loan to value ratio, which means that you're putting down more money when you're purchasing the home. Usually fully amortizing, which means that at the end of the loan, there's no outstanding principal balance. And a fixed rate. Throughout the life of the loan, the interest rate remains static. Let's contrast that with a subprime adjustable rate mortgage. These generally have a higher loan to value ratio because you put less money down. They're non-amortizing sometimes, which means that at the end you're going to have a balloon. These are interest-only loans. In the most recent iteration of subprime loans, which have been around for a while, we tend to think that they're brand new. No, they've been around for a while. But interestingly enough, in the most recent iteration of subprime loans, we're seeing a lot of loans that have these teaser rates, these low introductory rates, that at some point very early in the life of the loan are going to reset, maybe at 6 months, maybe at a year, maybe at 18 months. Well, let's set the stage. We have the ingredients for a perfect storm. First ingredient: low interest rates. Interest rates prior to this recent housing crisis were at an all-time low. Add to that rising home values. At the same time that the interest rates were low, the home values were high. What this produced were a number of people that were trying to get into houses, but the only way that they could get into these more expensive houses was to take on these subprime loans. Because you know, when you're paying your monthly payment, you have two components to your payment. You have your interest payment and your principal payment. The value is high, so your principal amount is going to be pretty high. If we can lower that monthly payment by making the interest rate low, you can afford to get into a higher priced home. Overlaying all of this, and this is going to be especially important considering that we're talking about the impact on minority buyers and minority neighborhoods, is the governmental push towards home ownership. There was an explicit governmental push put on by the administrations, both the Clinton administration and the George Bush II administration, towards a deeper, for more home ownership in minority neighborhoods. They said to Fannie and Freddie, you have to go out and you have to make more loans in minority neighborhoods because we want minority home ownership rates to rise. Well, you know what? It worked. In fact, home ownership rose across the United States, and home ownership rose in minority neighborhoods. However, the loans that were obtained by these two constituencies were quite different. If we look, let's take 2006 as our year of discussion. In 2006, if you look at the universe of white borrowers that obtained loans that year, 22% of them got subprime loans. In that same year, 53% of the loans that were originated to black borrowers were subprime loans. 41% of the loans originated to Hispanic borrowers were subprime loans. What does this mean for the neighborhoods? Unfortunately, in this country, we still have pretty segregated, racially and ethnically segregated neighborhoods. So the deeper penetration of subprime loans to minority borrowers meant a disparate impact on minority neighborhoods. In fact, if a neighborhood was less than 10% minority, approximately 22% of the loans in that neighborhood were subprime. If a neighborhood was greater than 90% minority, 48% of the loans in that neighborhood were subprime. And you're probably sitting there going, wait a minute, there's probably something else here at play. Perhaps it's the credit worthiness of the people living in those neighborhoods. Maybe they have bad credit. Maybe they don't have the economic resources to put down a lot of money. Maybe that can explain why there's a greater incidence of subprime loans in minority neighborhoods. And no, okay? That's not the reason. This country has a long history of racial discrimination for home lending. This is the map put out in the 1930s by the HOLC, which is a governmental sponsored agency that determined where the government would subsidize, would insure home loans. This is where the term redlining comes from. The neighborhoods that you see in red here, the government would not underwrite the loans. And there is a one-to-one correlation between the neighborhoods that are red and being a minority neighborhood. But wait a second, that's 1930s, that's a long time ago. As recently as 1988, HUD did a study and they found that black neighborhoods had a 5 times greater chance of subprime mortgages than white neighborhoods. So it's not the creditworthiness of the borrowers. Study after study has consistently shown that even if we hold constant the credit score of the borrower, minority neighborhoods and minority borrowers have a greater incidence of getting subprime loans. Now, I'm not going to describe, venal intent, pure racism. That may be a part of it. In fact, I want to introduce a stark economic decision that a lot of lenders were making. The subprime loan market was in large part driven by the fact that you just made more money originating a subprime loan than a prime loan. You got more money in fees, and also you were feeding the voracious appetite of the secondary market. I don't know how many of you have studied the secondary mortgage market and the impact of CDOs. We won't get into that here. That would take another hour for me to explain all of the CDO implications. But there's something else working in the background here that's pushing lenders to give these subprime loans even when the borrower may have qualified for a prime loan. So it's not just race and ethnicity. Very important factors are things like financial literacy, understanding the market, sophistication, that allowed lenders to saturate the minority markets with subprime loans. Well, these loans are fragile, okay? They could not withstand the storm when it hit. 2007 going into 2008, we start to see a couple of things. The first, rising interest rates. Remember I said that interest rates had been held really low. Well, the Fed took the lid off of the can in 2007 and interest rates started to rise. Well, at the same time that interest rates started to rise, remember a lot of these loans have resets. So suddenly people were saying, well, wait a second, I have to reset at this higher rate? I can't pay this whole thing now. Okay, fine, I'll just sell my house. I'll just get out of it. Nope, guess what? Stagnant home prices and the market just falling out meant that you were stuck. You couldn't move. This decimated urban neighborhoods. In New York, defaults were 3 times more likely. in minority census tracts than in white ones. 85% of the worst hit neighborhoods had a majority of Black and Latino borrowers. In Chicago, heavily minority neighborhoods, we're defining heavily minority here as greater than 80%. Heavily minority neighborhoods accounted for 65% of all foreclosure cases. In Cleveland, census tracts with high proportions of Black borrowers correlated to the highest incidence of foreclosure. And in Boston, 50% of changes in, this should be minority homeownership, in 2007, half of the houses that changed hands in 2007 in minority neighborhoods were as a result of foreclosure. Borrowers fought back. Remember, these were people that were getting loans not based on what they could pay, not based on their credit worthiness, but rather based on their lack of sophistication and in large part, their ethnicity. One of the largest settlements just happened. Bank of America, who owned all of these loans as a result of its countrywide acquisition, just settled. In this case, the borrowers said that Bank of America, or Countrywide, charged 200,000 Black and Hispanic borrowers higher rates and higher fees. The suit contended that subprime loans were often offered to borrowers even when they qualified for prime loans in 10,000 cases. Minority borrowers were 3 times more likely to get a subprime loan than a white borrower. Particularly in California, what was happening is that Countrywide was advertising in Spanish language and was losing a lot in the translation, literally, to Hispanic borrowers. The result of this was a $335 million settlement that was just ratified a couple of weeks ago, with the money to go to the aggrieved borrowers. Now, although this was the biggest one, this wasn't the only one. Recently, there have been other settlements. Mortgage Master, that's the largest mortgage lender in the state of Massachusetts, just settled a similar case for $250,000. CNF Mortgage in Virginia settled a case for $140,000. And AIG settled a case. They brought that in Delaware, but it had nationwide implications. I just have to read you the list of cities where the AIG settlement affected. It affected New York, Atlanta, Baltimore, Birmingham, Philadelphia, Orlando, Tampa, Chicago, Detroit, Cleveland, Hartford, St. Louis, Kansas City, Portland, Phoenix, and Las Vegas. I think the AIG settlement is also important because not only are they paying $6.1 million to the aggrieved borrowers, but they had to put in an additional $1 million for financial education and literacy. So where does this leave us? I think it leaves us with hope. Hope that in the future, borrowing is going to be done with a goal towards transparency, with a goal towards lending parity, and less based on the ethnicity and race of the borrower, which can only lead to greater financial stability for America's homeowners. Thank you.